In order to determine the financial health and long-term profitability of your entire portfolio, you need financial data to support the asset. In most organizations, this data can be hard to find and difficult to access.
Today, we're going to be talking about the real estate ecosystem and breaking it down to the lowest common, most simple principles and building up to show you how the various real estate technology stakeholders and real estate stakeholders interact with information within the real estate ecosystem.
To determine the long-term profitability of your real estate portfolio, you need to start with the financial data, the revenue versus the expenses. In real estate, everything starts with the property, the building. Each building is made up of units, each unit has tenants, and each tenant has a lease, the revenue. From a financial perspective, we look at the property's data in three ways. History, short-term financials, which span 3 to 5 years out, and long-term financials, or forecasting, which look out over the next decade or more. To translate this data into a financial model, we need to factor in revenue from leases, operating expenses, and capital expenses. To determine the financial health of the property, we use a combination of the historical data plus the revenue and expenses. The short term tells us how much money we are making right now versus how much we are investing and spending. The long term tells us how the property will perform over the next decade or more. Your property managers focus on the short-term horizon and determine the expenses and capital investments for the property. Your leasing agents are concerned with the revenue, which is determined by tenant activity. For example, who is moving in and who is moving out. Together, this information forms the basis of your financial model. There is an entire network of people outside an organization who need access to the financial data of a company's assets for a variety of reasons. For example, when purchasing a new property, an organization would apply for a loan and work with a lender.
So the lenders, a bank, they want to understand the financial health of the building, how much revenue it's generating, how much expenses it's spending, and how much capital is being spent in it. So they want to know at the end of the day that the money left over from this building is going to be enough to be able to pay for the mortgage on an ongoing basis. So the bank has to do their own analysis. They have to understand the historical performance of the building. They want to understand the current rent roll, so who are the tenants in place in this building today, what do the expenses look like today, and what is the capex forecasted over the next 1 to 3 years. They want to use that information and build up their own financial model for this property over the next 10-20 year period, so they can come up with a valuation and decide how much money they're willing to lend for this building, knowing that their investment is secure. So the lenders will work very closely with organizations, and they'll want to get this information so they can build up their own financial model.
Similarly, if you are buying or selling assets, you would use a broker. In this case, the broker needs the property data so they can broker the best possible deal based on the financials. In public companies, auditors are required to provide a valuation on their clients' assets. They too need all the financial data to help them value the portfolio and provide their statement of work for the annual report. When an organization has a large portfolio of properties, they have an internal team who manage the entire portfolio. The asset managers work on groups of individual assets and focus on the long-term forecast. To help them create a valuation, they make decisions like, should we upgrade the elevator shaft if we are selling the property in 12 months? Or, when is the best time to buy or sell the property? The methodology they use in North America is discounted cash flow, DCF, valuation based on a 10-year forecast. They start with a baseline of historicals and include the detailed assumptions. With this information, they can make decisions for the future. For example, they may have a tenant whose lease will expire in 7 years. The portfolio managers take a higher-level look at the entire portfolio. They make decisions like which regions and what types of properties to invest in. The fund manager structures the joint venture partners. They find partners, structure the deal, and manage the investment. Treasury looks after the debt. They manage the debt contracts. Since a covenant breach can be detrimental to a company, they focus on the covenants, ensuring healthy loan-to-value and debt service coverage ratios. The combination of all the data garnered from the asset managers, the portfolio managers, the fund managers, and Treasury will make up a complete financial model.